Bitcoin in your 401k and private equity, is that the right move for you? Social Security, is it on track or is it going to be run out of money in the next 10 years? And conflicting advice, can you retire with 1.5 million saved? All that and more on today's episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimpson and Casey Elkins.
Welcome into Elevate Your Wealth. Your host, Mark Stimpson, Casey Elkins, Steve Flynn. You can find them right here in Seattle. Elevated Financial Management, 42 plus years combined experience in the retirement planning business, helping their clients get ready for the big day, that retirement that they've worked so hard for. And again, they're certified financial fiduciaries. I'm Morgan Patrick. Absolute pleasure to jump on and talk about the latest. And again, we get into a more customized radio show where we talk about the hot topics when it comes to planning. Before we dive in on our first article, guys, how was the week? Casey, we'll start with you.
It's been great. The Mariners are playing good. I don't know what else we could ask for in Seattle. So we're really excited about that. We're big Mariners fans here. The Seahawks are doing well. We just need a basketball team, I think, to round it all out. So hopefully we'll get that one of these days. Things have been great around the office. We've been really busy. We got quite a few folks from the radio show last week that we've been able to help, which is really nice. And it's really nice to have people come in that listen to the show, that we get a lot of nice compliments. And it's really a nice privilege for us to be able to help folks like that are looking for help, right? That are trying to figure out, how can I retire? How can I be successful in my retirement? What to do? That's why we're going to talk about it a little bit today, but we wrote our book, Break the Glass, because it is ultimately, there's so many questions when you're approaching retirement. When do I take Social Security? What do I do for my medical, for Medicare, right? What can I do with my 401k? How do I make sure that it lasts? All those kinds of things. What are taxes going to do? How is inflation going to affect me? And it starts to feel like this very frantic thing for people. And so, it's really nice to be able to provide a copy of the book and just talk through those details with everyone to help put together a plan. And it truly is a privilege for us. So maybe it's a good time for us to say thank you. Thank you to the listeners. Thank you to the families that we're able to help. It really is our privilege and our honor to be in that trusted position.
I think those are very, very strong and kind words. And listen, we do talk about just the importance of getting everything lined up for you when it comes to your retirement. It relieves a lot of stress. Can't take it all away, but a whole bunch of it. Mark, how was your week?
Yeah, same thing as Casey just mentioned. Not only that, but the Huskies are playing some good ball. We like a little college football here as well. And Casey mentioned something to our listeners, if you don't know, we are now on New Day Northwest a couple of times a month now, as well as our show on Sunday night after the news. So we're really trying to help educate. We had a class last week at Green River Community College that we did, had a successful turnout there. So our goal is to really help everyone that's listening or watches our show to learn about ways they can create and have a successful retirement and not be just a fairy tale. So education is really, really important for us. And I'm very thankful, like Casey mentioned, to all those that trust us with their life savings and their grandchildren, helping them as well sometimes, and their kids. So we're very thankful to be in this business and be a part of making such a wonderful, I can't even think of the word right now, but anyway, a wonderful hope that we can give people that when it comes to retirement planning.
Last but not least, from southern Seattle, Steve Flynn.
With that southern Seattle accent. Yeah, no, and I was just thinking about the workshop we did at Green River. It was really nice to meet people in person and go over some of the questions that a lot of people have when we cover these topics. It's really nice to interact with the audience and share what we do here at Elevated. And we've got some more coming up, actually. We've got Renton Tech. We've got
Bellevue College,
yeah.
Highline College.
Highline, so it's a great opportunity to meet us in person and ask those questions outside of booking a formal appointment.
Yeah,
so,
And anybody that wants to attend those, if you listen to the radio show, you watch our TV show, if you go to our website, there's a list of events there, and we're constantly updating that so you can register to come to the event. It's no cost. It's absolutely no cost. There's no obligation. You can come and learn And realistically, it's a pretty focused hour and 15 minutes, and we talk about Social Security and market investments and taxes and all the things that we talk about on the show. We're able to get into a little bit more depth in a classroom setting. But that has been really nice because it really does. It gives us an opportunity to continue to help people.
Well, I mean, and it also shows that people are starved for information, for
Right.
education
Yeah.
in this area because we're in uncertain times and you want to have a plan. So that website, check it out, efmnw.com, all letters, efmnw.com. Any event that's coming up, you can catch it there. Also, links to the TV show, radio shows, and podcast form. Again, efmnw.com. All right, gentlemen, nicely done. Now we get into the first article. Highly alarmed by the opposed changes to retirement accounts. And this is the quote, "I don't want Bitcoin or private equity in my 401k. What can I do?" You guys went to the money list for this article. Very interesting.
Yeah, this is something that I think can cause a lot of trepidation for people. Most private investors don't get to participate in private equity, right? That's usually more of your very high net worth individuals. There's less security around private equity, less oversight. And, we've all know what Bitcoin is for a long time. There are still many individuals that are out there that don't understand what blockchain technology is, let alone Bitcoin or Ethereum or, the Trump coin, whatever we want to talk about. There's a lot of things out there in that world that people just don't understand. And so there's a little bit of trepidation about putting these inside their 401k plans. But it can also possibly bring some opportunity for some pretty decent growth if it's regulated in the right way and there's enough transparency and education about it. I think that's the key, is helping people to understand how these different investments, especially, Bitcoin and the private equity side of things, because it's a world that most people are not familiar with. But it can also provide an opportunity to make some decent returns when the market is performing the right way. So I just think people need to be educated about this.
Yeah, they do. And again, right, we talk about it all the time. It's the boogeyman, right? And rightfully so, right? If you don't understand it, it's going to be scary. And we get that. But oftentimes it comes down to education surrounding the investment. Now, we're not advocating for Bitcoin or private equity in our clients' accounts or 401ks or anywhere. If you want that to be part of your portfolio, we're not saying that you shouldn't either. Mark and I both have some level of cryptocurrency, and that's okay because it's a small portion of our holdings, right? That doesn't make up the overall financial picture of our lives. And so we would say kind of the same thing for folks that are looking at their 401k, and maybe, as the ETFs do become more and more popular, the different trusts and that kind of thing, maybe they do have a place in your portfolio. It's probably 5% or less, right? It's a speculative investment, but man, when you look at the growth of Bitcoin, it's been huge, right? And I'd hate to think that people miss out on potential growth in their investments because they want to stick their head in the sand and just choose to not be educated about what the options are. Now, if you're educated about it and you still don't want to be involved, great. There's nothing wrong with that, right? That's absolutely up to you. But we would say, open the door and figure out what that boogeyman looks like before you start making judgments, right? Look under the bed, pull the sheet up, and figure out what that could really mean for you.
Yeah, it really boils down to maybe just having too much of a concentrated position, right? We know that we have a client that he got really aggressive after working at Boeing for 44 years, and he put everything in Boeing stock, okay? One of the best stocks on the Dow for over 2 decades, right? It's been the main driver of the Dow, but it really backfired on him when the door blew off the plane because the stock plummeted. Same way if you have over concentration of Bitcoin or any other cryptocurrency, or you don't understand private equity. I think you got a thought on that?
Yeah, I was just thinking too, a lot of our clients in 401ks don't actually know the underlying investments. Yeah. Mm-hmm. They're in a certain type of fund, like a target date fund, like 2035 target date fund. And we kind of unpack that and say, hey, did you know that fund, the majority holding is, for example, a couple of tech stocks. So this is kind of revealing for us too.
That's it. Yeah, it is, right? Look under the hood and figure out what's going on. And so, maybe this is a good time. I think we can open up the phone lines, right, Morgan? We'll give the phone number here in a second for those that want to come in and see us. But this is an opportunity to have a review of your investments, to understand how you're invested and figure out, are you on the right track? Is this the right path for you? It's an opportunity to ask questions and start to put together a plan and see what all of this could look like. But if you're concerned about taxes, you're concerned about the investments, about keeping up with inflation, creating income in retirement, when do I start Social Security? What's Medicare going to look like? All those things, this is your opportunity to start to put something together to figure out how to create success for you. Don't hesitate. Pick up the phone and give us a call.
We've got 10 complimentary appointments. Again, if you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. But again, there's no cost to this. There's no obligation, meaning you're not agreeing to become a client. This is a great way to test drive Elevated Financial Management and meet the team. 866-668-3625. That's 866-668-3625. If you're sitting on a portfolio, you've been thinking about possibly taking this step down the path of planning, this is your opportunity. Again, no cost, no obligation. If you're in the middle of something, you're frustrated, it's okay. Get a second opinion. Call this number, 866-668-3625. That's 866-668-3625. When we return on Elevate Your Wealth, we're going to get into Social Security. It's on track to be gone, possibly in 10 years. We'll talk about that coming up next. We are back on Elevate Your Wealth. Your hosts, Mark Stimpson, Casey Elkins, Steve O'Flynn, all can be found right here in Seattle. Elevated Financial Management, the website, it's a resource. Check it out. EFMNW.com. All letters, EFMNW.com. We've already told you on the program this week. Any event that's coming up with Elevated Financial Management, you can find at the website, plus the TV show, links there. You've got the radio show in podcast form. Great information on retirement, background information on the team. Again, the website, EFMNW.com. And they've got well over 42 years combined experience in the retirement planning business, certified financial fiduciaries. I'm Morgan Patrick, a pleasure. We're going to tell you not only about the latest on Social Security, we're going to give you more information on the book, Break the Glass, that the team has put out. BreakTheGlassBook.com is the website. Check it out. You can sign up for a book there. That's breaktheglassbook.com. All right, gentlemen, Social Security on track to be insolvent in less than 10 years. This is an article, obviously, that caught your eye, and I would imagine it's because so many people are leaning heavily on Social Security. It should not be your only thing, but a lot of people are making it a big part of their retirement.
Yeah, in fact, it's for some of our clients and students that come in, it is their only part of their retirement. That's why this is a big deal for a lot of people. We need to understand what's really happening. I'm a nationally certified Social Security advisor, and I get Social Security, but one of the things people have a misconception about, they think that their payment that they get each month comes out of the trust fund. It doesn't work that way. People that are working, pay taxes, right? And those taxes are what is the majority of the money comes from those taxes collected each and every month. And that's what they use to pay out people's retirement checks. That's where it comes from. One of the bigger issues is less people working. The population isn't growing at the pace that would be good to help keep the working numbers up, right? And so because of that, it's putting stress on the trust fund. And there is a very high likelihood that if some major changes aren't done, it could run out of money now in about 9 years. And so this is something everyone that's listening needs to understand. Is it going to go away? I don't believe that for 1 second. I started my Social Security about 6-7 months ago. So, the bottom line is Social Security is a major part of, we call it the three-legged stool. And the reality is because pensions have gone away, Social Security for a lot of people might be the only guaranteed source of income that they have. So this needs to be understood, and we do need to make some changes with Social Security. Hopefully they're going to get their whatever their thinking is corrected and make some changes, right? Otherwise, this could be a real big problem.
Yeah, it's true. And I really agree with you, Mark. The idea that Social Security is going away, I mean, just think of the implications across the country for that, right? I mean, that's just not realistic, right? To think that, because there's a lot of people that is maybe their only source of income, but for a lot of people, it's definitely their main source of income in retirement. Now, that is not as much the case in our area because we're in a high income area. We have a lot of people here that have been great savers. And so they're producing a lot of income from their investments, which is great. But you look at other areas of the country, there's a great deal of the population that is their majority income in retirement. And so if that was to just go away, I mean, you would have multiple generations rioting in the streets, because when mom and dad no longer have money and they're too old to work and go create their own income, what do? Their only option is to lean on their kids, right? And now the kids, their retirement is going to be strained. So that has a cascading effect generationally. And so I don't think it's realistic to think that Social Security is going away. Now, what is it going to look like? How are they going to fix it? A lot of that remains to be seen, right? But I believe that they will have a plan to fix it.
Yeah, and it's the phrase that we hear so often is Social Security going away. That's the phrase. So we like to put it more realistically. And so some of the proposals that have floated around Washington to address the financing issues include raising the retirement age, which is currently 67 for anyone born in or after 1960, raising the payroll tax, which is currently 6.2% for employees and 6.2% for employers, eliminating the income cap, which would require more high earners to pay into the system, and adjusting what benefits are available. So we don't think it's going away, but we certainly think there's going to be some adjustments going forward.
Yeah.
I think in a nutshell, what Steve just mentioned, I think raising the retired, what we call full retirement age, going to 70 is going to be something that very easily could happen. I think it might affect our children and our grandchildren, but I also do believe, like Steve mentioned, if we right now you only pay tax, Social Security tax on about 100 and I think that it's 162,000 this year,
like
right?
that, yeah.
Really close to that. And if you make $400,000, I believe we should pay tax on $400,000. That would really help a lot of the shortfall that the trustees report is worried about. It'll be interesting to see. Not that I want to pay more tax, but I also believe that that's a tax that we're getting a true benefit from. And so if we do that, that might help plug the dam hole just a little bit here. So again, some changes are going to happen. Otherwise, there is going to be a problem.
Plug the dam hole, plug the hole in the dam, right? I like that. I like that. It works either way.
Over here, Morgan, we're keeping it G, okay?
Works either way you say it. And listen, folks, it's very important that you understand, and Mark, you said it, there's so many people out there that, Social Security is going to be the end-all, be-all of their retirement. So my question to you guys, as a group, you have somebody come in, let's say they're 15 years out, maybe 10 years out. They're approaching the red zone. They don't have much more. What can they do in this final stretch before retirement if they're going to lean heavily on Social Security? What else can they do to kind of ramp up their savings, start putting money where it needs to be to work for them?
It really comes down to maxing out their savings. I mean, that is it, right? If you are concerned, I mean, we should all be some level of concerned about where Social Security is going, right? But if you're truly under the belief that it's going away or any of those things, you're never going to look back and wish you'd saved less for retirement, right? I've said that before, and it really is the case. You're not going to get to 70 and think, man, I've got great income and good investments. I really wish I hadn't saved. Like that's not a thing, right? So save now, because it's not timing the market. It's not buying and selling and buying and selling and trying to get the right time on your investments. It's time in the market that creates success. That's really the key behind this. So the more you can get in up front, that compounding growth over the years and allowing those investments to roll. If you're 20 years from retirement, now is the time to be aggressive with your investments, right? If that's the case. Now, most of the folks we work with are 5 to 10 years from retirement, right? So we're actually kind of giving the opposite advice of, well, now is the time to start considering how much risk you're taking. And is it too much, right? But it's all based on how close you are to retirement. And that's something that we talk about in the book, about creating income and creating the investments or having the right investments to create income and being efficient tax-wise. And what do you do for your Social Security? So that's Break the Glass. That's the name of the book. If you'd like to get a copy of the book, we're making it available for folks that listen to the show. You can go to breaktheglassbook.com. That's breaktheglassbook.com. Enter your information. We will drop one in the mail to you. There's no obligation behind it. There's no requirement of anything. It's a good read. It's a relatively short read, but it's something that Mark and I are very proud of, that we worked really hard to make sure that it's palatable for retirees. It's not meant to be a textbook, right? That's not the purpose behind it. It's not for the PhDs of finance. That's not the goal here. The goal is to try and take financial concepts that we use every day and put them into plain language so that retirees have something that they can really, put in their minds and create a successful retirement with.
Yeah, there's a nice section we've been talking about Social Security. There's a big section in our book on Social Security. One of the main problems today is that pensions no longer exist.
Yep.
So how do you replace that second leg, right? And the people, my grandparents, my parents, they had pensions, right? And it made it so much easier for them in retirement because they had a second guaranteed source of income. So if you're listening right now, you're wondering, where's my income going to come from? You're worried about Social Security. Is it going to go away? What about Medicare? How do I pass money on to my children in the best possible way? All of this and so much more, we can help you if you'll call the office. Let us help you put together a plan specifically for you and the assets that you've accumulated. If you've saved at least $250,000 or more, that this type of planning is going to benefit you the most. So please pick up the phone, give us a call. Let our team of planners put together a plan that'll help make your retirement a true success.
Opportunity right now. We've got 10 appointments. Again, if you've saved $250,000 or more towards your retirement, these strategies going to work best for you. This is your opportunity. Grab an appointment right now, 866-668-3625. That's 866-668-3625. Again, we call it our top 10. If you get in the first 10, you're in this week. Again, that's 866-668-3625. Outside the top 10, short wait list, 2 weeks. This is a busy office, folks. Take advantage of this opportunity. Call the number right now, 866-668-3625. If you have any questions about where you are, maybe you're in that 15-year out category. Maybe you're 10 years out from retirement. Things that you can be doing right now. First thing, you got a plan. Call the number 866-668-3625. That's 866-668-3625. When we return on Elevate Your Wealth, we are going to get into this. I've received conflicting advice. I'm retiring at 63 with $1.5 million. Is it enough? That's next. Welcome back into Elevate Your Wealth. Your hosts are Mark Stimpson, Casey Elkins, and Steve O'Flynn. Elevated Financial Management, where you can find them right here in Seattle. Well over 42 years combined experience between these three in the retirement planning business. And again, Mark and Casey, certified financial fiduciaries. I'm Morgan Patrick. Just a pleasure jumping on and talking about retirement. Now, you're out, you're about, and you're busy. We get it. You're listening to the show. Well, at any time, you can check the website out because it is a resource for you. Again, EFMNW.com, all letters, EFMNW.com. And as Casey and Mark both said earlier in the program, any event they've got coming up, it'll be listed there for you. They got an events tab. You can sign up for those. Also, the TV show, links are there, our radio show in podcast form, but just good information on retirement and planning, as well as background information on Casey, Mark, and Steve, as well as the entire team. Again, always a pleasure jumping on talking retirement. We will give you an opportunity to sign up for their latest book, Break the Glass. And we'll tell you about that as we move through this portion. So, guys, I've received conflicting advice. I'm retiring at 63 with $1.5 million saved. Is 70-30 equities bonds too risky? That's how this article starts off.
That's a really good question, and it's something that we get questions similar to this all the time in the office, and that's why this stuck out to us. Oftentimes it's 60-40, right? We hear a lot of 60-40. And so we'll kind of be talking with somebody and ask them, how are you invested? What does that look like? If you have a current advisor, how did you guys set that up? And sometimes the response we get is, well, I'm 60-40. So I'm very diversified and I'm very conservative. Well, that really depends on what the 60-40 is. 60-40 is a very high level way to look at things. 60-40 would say 60% stock, 40% bonds. The article is referencing 70% stock, 30% bonds. So, if the underlying holdings, like let's say you look at that 60% that is stock, if it's all NVIDIA stock, yeah, you do have 60% stock, but that's also a very aggressive holding, right? So it may not be as conservative as you think it is. The opposite of that is true too, right? You may have all Coca-Cola. And Coca-Cola is not a very volatile holding, right? And it pays a good dividend. So you might actually be more on the conservative side. So I think our big takeaway from this, and we're going to get into the article more, but our big takeaway is that 70-30, 60-40 doesn't tell the whole story. I mean, that's painting with a really broad brush. Yeah. And there's a lot more details to be had about how those investments are structured and how they perform when the market is volatile.
Yeah, I wanted to piggyback that with Casey really quickly, because it truly, we could say 70-30 could be perfect, or we could say, no, we don't want to do that, right? It's all about having a plan, because if we have a nice chunk of their assets going to create income mode, or this is why the plan matters. And we talk about the red, yellow, and the green buckets all the time on our shows and our TV shows, radio shows. But the bottom line is, if we have a big chunk of their money protected, we could easily go for the rest of the money in a very aggressive position, right? Because we're looking at that as long-term money, 10, 15 years down the road. So this is very unique to each investor, especially kind of where they are age-wise. So there is no right, should it be 55-45, 60-40, 70-30? Like Casey mentioned, we need a lot more information, because if a plan has been put together, 70 might be really smart on the red bucket of money if we have a bunch of the other assets taken care of. So it's just something that it's an individual situation where we need a lot more info before we can tell them what might be right or wrong.
Yeah, I think the word is depends, right?
Yep.
Totally according to your individual circumstance. And $1.5 million, it's no small amount of money. That's a lot of money. But the next question we would ask as part of our planning process is, how much are you looking to spend in retirement? And that will really determine how long that money can last, what investment strategy we should have. So.
Right. Yeah, and it is. I mean, Steve, you hit the nail on the head, right? It really does come back to that. If you got $10 million saved, right, for most of us, it's like, well, that's great, right? You got a ton of money saved. That's wonderful, right? But then if you say, guys, I'd like to be able to spend $2 million a year in retirement, well, that's not going to happen, right? So it really depends on what you want to spend, right? That's really the key. So, we really struggle with this idea of, well, $1 million is enough for retirement. It depends on what retirement you want to have. There's more details to it than that. And, I mean, maybe you can tell. It gets me kind of worked up, some of these articles, because I think it's ridiculous to try and make these really broad statements. They're one size fits none, right?
You're pigeonholing.
It is, right? And it's really frustrating, because it sets up these markers of success in people's minds that probably don't apply to them, right? And it could be for the worse, it could be for the better, right? If we say, if you think of that and you say, well, you need $1 million to retire. Well, okay, but how much income is that going to create? It might be more income than you actually need, because if you have a great pension and a great Social Security, you maybe don't need $1 million to create income for yourself in retirement. Now, I don't think you're going to be upset that you have it, but you can still balance your today life with your future life, right? And so there's things to weigh out, but the opposite of that is true too. If you don't have a pension and you've got, let's say you got good Social Security, but you don't have a pension, $1 million to retire on in our area, it's going to be tighter than you think it is, right? Not that it can't be a successful retirement. We have folks do it all the time, but it also really depends on how much you want to spend in retirement. Is your house paid off? Do you want to travel a lot? Like, what do your expenses look like? So it really is situational. It really is dependent. And that creating income is so important. That's what it really all comes back to.
We want to give you an opportunity to grab a copy of their book, Break the Glass. This is complimentary. All you've got to do is go to the website, breaktheglassbook.com. That's breaktheglassbook.com. Sign up there, put your information in. They'll ship you out a copy of this book, Break the Glass. Again, that is a copy of their latest book. It's breaktheglassbook.com is the website. Go sign up there. We're going to give you an opportunity to get into the office with an appointment. We call it our top 10. First 10 are in this week. After that, you go on a short wait list to get in to the top 10. Call the number 866-668-3625. That's 866-668-3625. I want to go back to what Steve said. And I think it's the key word. It depends. It depends on your individual situation. And one thing we haven't really talked about, and I'll throw this out, and you guys can chew on this because I know you're going to hit it like blood in the water and sharks, but $1.5 million, where's that money? Is it in tax-deferred accounts? Because if it's $1.5 million in tax-deferred, you have a partner.
Yeah, that's a good point too. Where is it? Is it in a Roth? Is it after-tax money? Is it tax-deferred? Yeah, and they're really important factors, especially, from a tax perspective. But another thing I was thinking is, which bucket is that money in? And when we look at 70-30 equity bonds, we've got the three buckets. Yellow is liquidity, cash. Green is safety, income. And red is at risk. And we would still say that a 70-30 equity bond portfolio is, as it stands, in the red bucket. It's at risk.
Yeah, it is. Yep. And that tax piece is really important as well, right? Because that means that, so let's say you've got risk because it's all invested in the market. That's one level of risk. If it's all invested in an IRA or a 401k, you got a silent partner, just like you said, Morgan. So now that money's at risk in that way, right? Because, you think about it, what the tax rates were when you saved that money, right? When you put the money into the account. But nobody told you what the taxes would be when you started taking it out. There's no guarantee on that. And your silent partner, which we all have in our tax-deferred accounts called the IRS, they get to change the rules whenever they feel like, right? And they don't run it by you to see if you're okay with it, right? So those tax brackets get shifted without your permission. And that has a direct impact on your retirement. So how that money's invested, where it's invested, is really, really important information, and something that you have to be considering when you're creating a retirement plan, right? If your retirement plan doesn't account for where the investments are held and how they're held, I don't think you have a plan. That's really not a plan. That's just a bucket of holdings, right?
Yeah, I want to maybe share one paragraph out of this article. I thought it was important, talking about how we got to be considering caveats that can happen. This is the point. You're retiring into an uncertain economic and political backdrop. We have wars in Ukraine and Gaza, the bombing of Israel by Iran, Iran by Israel and the U.S., and U.S. foreign policy has broken with the post-war Western alliance, stock market volatility, and then the tariff situation on our new administration. So there is.
Come on, Mark. What's uncertain about that? What's uncertain about that?
Exactly.
It seems so secure.
So what should we do, right? This is the point. It's like, nope, everybody's worried about this, and I understand. I would be too. There is a lot going on that is completely out of our control, right? So if you have a plan, though, it's going to help tremendously when we have to deal with this sort of geoeconomic uncertainty that is probably as high as it's been in the United States for the past 100 years. I mean, we're in unprecedented territory right now, and so we all need to have a plan.
Mm-hmm. It is. It comes back to that plan. And here's something else from the article to kind of get back to the initial thought that we were talking about. And this is the thing that I struggle with when we look at investments like this. It says, given a guaranteed income of $110,000 a year, and then it says this, a 4% withdrawal rate. So what that means is they're taking this 1.5 and they're going to take 4% a year, kind of indefinitely, right? Well, the 4% rule has been debunked, and there's a lot of challenges questioning if you can even take 3%, nonetheless 2.5%. And then it says, assuming a 10% return on your stocks. Man,
that's a nice return.
Yeah, it is a nice return, and I hope you get it, right? And I hope all of our clients get 10% or more. But if that's what you're planning on, right? If that's what you put into your plan, that you're going to average a 10% return for the next 30 years of your life, man, I got a lot of questions about who put that plan together for you, right? Because that plan is not based in reality. And so this is your opportunity. You've been listening to the show. You hear what we talk about. Exactly who you hear on the radio is exactly who we are in the office. There's no obligation. It's completely complimentary. We will sit down and talk about your current finances, your current investing strategy, your time frame to retirement, what you want to do in retirement, how to be tax efficient. Is your money going to last? All those types of questions. So if you've saved $250,000 or more, don't hesitate. Pick up the phone and give us a call.
Yeah, get into our top 10. These are 10 complimentary appointments this week. 866-668-3625 is the number to call. That's 866-668-3625. First 10, you're in. Outside the top 10, short wait list. We'll get to you in the next couple of weeks, but you will get an appointment. 866-668-3625. Again, busy office. Get in here. 866-668-3625. When we return on Elevate Your Wealth, we'll dive in on some scenarios we've gathered from around the country, see how the gentleman will handle them, and that's next. Elevate Your Wealth, hosted by Mark Stimpson, Casey Elkins, and Steve O'Flynn. You can find them right here in Seattle. Elevated Financial Management, over 42 years combined experience between these three. And again, it's all about helping their clients get ready for retirement. They're certified financial fiduciaries. I'm Morgan Patrick. We jump on, we talk retirement. We give you an opportunity to take action on your own behalf. And when I say that, I mean grab a complimentary appointment. When I say that, I mean go to the website and grab their book, Break the Glass, and that's breaktheglassbook.com. Sign up there. They'll send you a copy. It's complimentary, breaktheglassbook.com. And to grab one of our appointments at any time to get into our top 10, simply call the number 866-668-3625. That's 866-668-3625. That'll get you signed up for one of those complimentary appointments. There's no cost. You leave the checkbook at home, and you're not agreeing to become a client. This is a great way to test drive Elevated Financial Management, see if it's a good fit. All right, scenario time, guys. Mark, we'll start with you. Here it is, and the rest of you jump in. They're in their late 60s and just watched a friend's long-term care costs drain most of their assets, and now they're wondering if insurance is worth it. The question, what are the real pros and cons of buying long-term care insurance in retirement?
Yeah, this is something that we believe needs to be discussed with every client that comes in, because many of you have heard me talk about this over the last several years. My grandparents on my dad's side, my grandfather got Alzheimer's and watched him pretty much lose everything, liquid assets that they had when he went to a nursing facility late in life. And, the bottom line is, in our area, we just had a client come in a couple of weeks ago, and the wife took care of the husband as long as she possibly could. In fact, it was close to 9 years. The dementia got pretty bad. She placed him in a facility finally. And, a harsh reality is you also deal with some guilt, when it's your spouse. But we understand how tough it is to be a caregiver with someone that's really struggling with bad type of dementia, Alzheimer's, maybe dealing with the sundowner syndrome and things like that. But there's only a couple of different ways that we're going to pay for long-term care, right? We're going to do what most people are doing out there. They're going to self-insure. They're just going to take their chances, and if it happens, they'll pay out of their own pocket. Back to that case I was just talking about, we know that the last couple of years she was paying over $20,000 a month.
20 grand.
20 grand. So think about that. Where's that going to come from? And somebody might say, well, my insurance premium is $7,000 a year. Man, that's really expensive. I don't think I should do that. Well, I would say compared to what? Compared to $20,000 a month, it'll look like peanuts. See, so again, long-term care insurance, and there's some really cool hybrid life insurance policies out there that are a way to solve the big problem with a lot of people that not only they think it's expensive, but they don't think they're going to use it, right? So the new policies, the standalones were what we called use it or lose it. Now there's hybrid life policies that have a death benefit. So if you don't use it, all of the premium that's paid comes back to your children or your grandchildren or charities, whoever you're leaving that money to. And that's really a wonderful way to get some leverage. Let's say you put in $1, but you have $3 in benefit to pay for long-term care. It can be a really, really purposeful way to address a problem that is real, that a lot of people just flat don't want to talk about. But it can, if there's an atom bomb that's going to blow up somebody's plan, it's going to be that, right, Case? There's just no two ways about that.
It is, right? And it's not a fun thing to talk about. I mean, we don't enjoy talking about it, right? But it's a reality, and it's something that needs to be discussed. And I think what this really boils down to is, again, it's education, right?
Yes.
It really is. People hear long-term care insurance, and I think sometimes maybe they just shut their brain off, right? It's like, well, I don't care about that. I don't want to talk about it. But you need to wake up, right? Because it's a very, very expensive thing to deal with. And if you don't have it set up in your plan, let's say you've got a married couple and you don't have long-term care essentially planned out for inside that plan, and you could have. If there is a long-term care event for one spouse, the other spouse, if they can't take care of them and they have to go to a facility, the other spouse that doesn't need long-term care may end up being essentially poor because of it, because all of their income is going to go to take care of the person that they love the most and try to give them the best care that they can. But now that means that the spouse who didn't need long-term care probably doesn't have money to do anything else, right? So this is something that all could have been addressed if the time was taken and the conversation was had. Now, the reality is getting approved for long-term care, you have to go through underwriting. It's not a fun process. That is absolutely the truth. But that doesn't mean that it isn't worth it. And not only that, but it's still a more efficient use of the dollars, like Mark was talking about, right? If you choose to self-insure, let's say you got $10 million, right? And I'm using big numbers just to illustrate the point. Let's say you got $10 million and you decide you're going to self-insure. Well, if you need $500,000 worth of long-term care in your retirement, it's going to cost you $500,000. Now, if you're paying it out of an IRA, it's going to cost you more because you have to pay taxes on that money, right? But let's say it costs you $500,000 for $500,000 worth of care. Whereas with a long-term care plan, let's say you could put in $150,000 or $200,000 up front and get $500,000 worth of long-term care. You're getting leverage on the money. So it isn't really about do I need it or not need it. I think most everybody needs it, really. It's just a more efficient way to go about planning for it if you can get approved.
Yeah, I just want to piggyback what Kay said, because we had a client where we just did a cool illustration where they put in $300,000 for their plan, but it also gave them almost 1.1 million of long-term care benefits. See, that's a 4-to-1 split, right? Now, age matters on this. The younger you are, the more leverage you get. But I think a key thing is, like Casey mentioned, if you don't do this while you're healthy and you wait and you have a problem, then it becomes a moot point because you're not going to be able to get it, right? So again, this is something that needs to be addressed when you're healthy, and maybe don't even want to think about it, but it's really the time that you need to be thinking about and dealing with this.
Right.
Yeah, and also I think there's the insurance marketplace has moved forward too. There's a misconception that you pay a premium and you never see that again. Well, it's evolved now. There's new products, as Mark says, the hybrid policy that's definitely worth a discussion and could fit as part of a plan.
Yeah, that's always a big hang-up, right? Is people are concerned, why pay this premium, and now the money's just gone. If I never use it, right, the money's gone, the insurance carrier keeps money. That's not the case, right? There are options that is not how it works, where instead that money that you paid in, and probably a little bit more, comes back as a tax-free death benefit to your heirs, which is where the money would have gone in the first place had you kept it inside your investment accounts. Yep. So it's a really nice way to cover it, but it starts with a conversation, and it starts with having an open mind to figure out if it makes sense for you.
Yeah, I mean, ask questions. Grab one of the appointments at any time. If you've been thinking along these lines, why not work with professionals and get your questions answered? To grab one of our 10 appointments, simply call 866-668-3625. Again, complimentary. You're leaving the checkbook at home. You're not agreeing to become a client. This is a great way to test drive, again, Elevated Financial Management. 866-668-3625. All right, next up, stepping to the plate like Cal Raleigh for the Mariners. This is Steve O'Flynn of the Elevated Financial Management. And here it is, Steve, your first solo scenario. They don't have a will or power of attorney, and their kids are asking questions. They're overwhelmed by where to even start. So the question for you and the rest of the team, what are the must-haves for an estate plan that actually protects your family?
Yeah, and estate and a legacy planning is a huge part of any plan. So they say they don't have a will or a power of attorney. Well, again, similar to the long-term care, the sooner we do these things, the better, especially as we get older and mental capacity diminishes. Power of attorney can be very important, and we want to make sure that we do that right. So having that conversation with, your next of kin, the person that's likely to be the executive of your estate, that makes sense to have that person as a power of attorney. And you can speak with an attorney about that. We will happily review that. There's limited and durable power of attorney. Also, getting a will or an estate plan involves having an attorney. But something we like to do and discuss when people meet with us is who is your beneficiaries listed on your investment accounts. Mm-hmm. Transfer on death, and
paid on death.
TOD and POD. And again, that's the first thing to review, because even if you had a will and you pass away and the will said one thing, but it's actually who is listed on your investment accounts as TOD and POD, mm-hmm. that money will actually go to.
I think it's really important on the powers of attorney. Remember, powers of attorney die at death, but they're critical. If you can't speak for yourself, let's say in a medical situation, who is going to make those decisions for you, right? That's why we need medical directives. Some will call it out there the living will, but we should have POAs for medical and financial as well, because somebody needs to be able to go in and pay your bills, help with those things, and we can do that very, very good with powers of attorney versus maybe putting our children on the account with us as a joint title holder, right? Because then if they get in a car wreck and kill somebody, they could look at mom and dad's account as theirs, and so there's some danger there, and that's why you want to really work with somebody that's going to be able to set it up the right way.
Yeah, it has to be set up the right way, right? And it is something that, again, not a fun conversation, right, to have that with the next generation. I mean, that's the reality of it, but that doesn't mean that we still can't plan for it. And not that you have to go into the exact details of everything. That's what the trust is for, right? So when that event does happen, mm-hmm. it's very clear to everybody what exactly is supposed to take place. And here's the thing. If you don't do that type of planning, then things are going to end up in probate. And more often than not, we see it cause ripples in a family. And it's just something that could have totally been avoided had you done the right type of planning.
Exactly. So if you're out there and you've been thinking about this, you haven't done much as far as making sure that your wishes, you have powers of attorney. Do you know what's going to happen with tax planning? We're very diligent about tax planning in this office. What about, do you have a plan where you know where your income is going to come from, and is it guaranteed or not? What about Medicare? What do I do there when I have Medicare A and B? And do I need a supplement? Long-term care insurance. We've mentioned all these things today, so please pick up the phone and give us a call. We've got a book that we will send to you, but just if you've saved $250,000 or more and you've got questions at all, just call us. All we're going to do is have a conversation. That's it. Leave the checkbook at home, but come see us at Elevated Financial Management.
All right, we've got the 10 appointments. Call this number, 866-668-3625. That's 866-668-3625. Again, these are complimentary, no obligation to become a client. And again, they're going to go fast. So if you get into the top 10, you're in this week. Outside the top 10, we'll set you up on the waiting list, and you'll get in the next couple of weeks. 866-668-3625. And as Mark mentioned, we have the book, Break the Glass. Go to breaktheglassbook.com. Sign up for it there. They'll ship it out to you absolutely free. breaktheglassbook.com. Another edition of Elevate Your Wealth is in the books. For Mark, Casey, and Steve, I'm Morgan. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.